Hi everyone, we are from Group Super 4. Our group consists of 4 members, myself Ratna, Bharat, Saravanan and Naga. Today the topic of our presentation is on corporate finance and we're going to analyze the ratios and prepare a report on company ABC Berhad's performance over the 3 years. The graph below showed the liquidity ratios of ABC Berhad for the years 2021 to 2023 indicate the company's ability to meet short-term obligations. The current ratio improved from 0.59 in 2021 and 2022 to 0.71 in 2023, suggesting a slight enhancement in liquidity. However, a current ratio below 1 indicates potential difficulties in covering short-term debts. Additionally, the quick ratio remained low at around 0.2, further indicating possible liquidity issues. ABC Berhad's activity ratios reveal a mixed performance. The figure below shows a decline in inventory management efficiency, though there was a slight improvement in 2023. The average receivables collection period has improved, but faster supplier payments could negatively impact cash flow. Additionally, the total asset turnover ratio displayed extreme fluctuations, raising concerns about data consistency and potential changes in the business model. Moving forward, ABC should prioritize improving inventory management and gaining a better understanding of these operational shifts. Based on the financial leverage ratios presented in graph below, ABC Berhad's debt management and financial stability show a complex and somewhat contradictory picture. The graph illustrates that the company's debt ratio decreased significantly from 4.27 in 2021 to 0.67 in 2023, suggesting a substantial reduction in overall leverage and improved financial stability. However, the same graph shows that the debt to equity ratio increased from 0.17 in 2021 to 1.07 in 2023, indicating a shift towards more debt financing relative to equity. The below graph, which depicts the times interest earned ratio, reveals a dramatic fluctuation. This ratio spiked from 0.37 in 2021 to 17.02 in 2022, but then plummeted to 0.27 in 2023. The sharp decline in 2023 is particularly concerning as it suggests ABC Berhad may face challenges in meeting its interest obligations. These contrasting trends between the debt ratio and debt to equity ratio, coupled with the volatile times interest earned ratio, indicate that ABC Berhad needs to carefully review its capital structure and debt management strategies. The company should focus on stabilizing its ability to service debt and maintaining a balanced approach to leverage to ensure long-term financial health.
Based on the graph below, depicting the profitability ratios of ABC Berhad from 2021 to 2023, we can observe a consistent downward trend across all three profitability metrics. The gross profit margin shows the most significant decline, dropping from 36.31% in 2021 to 30.92% in 2023, indicating a decrease in the company's efficiency in manufacturing or purchasing its products. The operating profit margin demonstrates a slight but steady decrease moving from 13.97% in 2021 to 13.55% in 2023, suggesting a minor reduction in operational efficiency. Similarly, the net profit margin also shows a gradual decline, falling from 10.21% in 2021 to 9.30% in 2023. This overall downward trend in profitability ratios indicates that ABC Berhad is facing challenges in maintaining its profit levels relative to its sales. The company may be experiencing increased cost, pricing pressures, or a combination of both, which are eroding its profit margins across all levels of its operations. This trend suggests that ABC Berhad should focus on cost management strategies and potentially reassess its pricing structure to improve its profitability in coming years. The return on assets, as shown in graph below, displays a declining trend from 19.31% in 2021 to 17.45% in 2023. This decrease suggests that ABC Berhad's efficiency in utilizing its assets to generate profits has slightly diminished over the 3-year period. Graph below illustrates the return on equity, which remained remarkably high and relatively stable. It fluctuated slightly from 99.20% in 2021 to 97.78% in 2022, before recovering to 99.04% in 2023. This consistently high ROE indicates that ABC Berhad is very efficient at generating profits from shareholders' equity. As depicted in graph below, the earnings per share shows a steady increase from 2.36 in 2021 to 2.65 in 2023. This upward trend in EPS suggests that ABC Berhad's profitability on per share basis is improving consistently over the years. Graph below presents two market ratios. The price over earnings PE ratio has been declining from 589.3 in 2021 to 529.24 in 2023, indicating high but slightly decreasing investor expectations. Conversely, the market overbook MB ratio increased from 2.37 in 2021 to 2.67 in 2023, suggesting that the market increasingly values ABC Berhad's shares more highly relative to their book value. Overall, ABC Berhad appears to be facing operational and profitability challenges while maintaining strong returns for shareholders, but may need to address liquidity and debt management issues to ensure long-term financial health. To improve performance in the coming year, ABC Berhad should focus on several key areas. Firstly, the company needs to enhance its liquidity position by improving working capital management, potentially through better inventory control and optimized accounts receivable processes. To address declining profitability, ABC Berhad should implement cost reduction strategies and consider pricing adjustments to improve gross margins. The company should also review its debt structure to stabilize its interest coverage ratio and ensure sustainable balance between debt and equity financing. Operational efficiency improvements, particularly in inventory turnover, could help boost the company's activity ratios. Finally, ABC Berhad should invest in innovation and market expansion to drive top-line growth, which could help maintain its strong return on equity and improve overall financial health.
Hi, good day. I'm Naga. So today I will answer the question 2. So it's regarding with pro forma income statement for the year ended December 31st, 2024. So here we are showing some calculation based on their statement for the year of 2024. So by looking at the statement, where we can see their cost of goods sold, which is 2,750,000 minus 1 million, will give them 35%. So the percentage was 35%. And if we look at their operating expenses, it's around 850,000 minus 250,000, which will give 12%. And their interest expense, it's around 200,000. So when we calculate, it will give us 4%. And how about their tax? Tax was 40%, and their dividend payout ratio was 40%. Okay. So if we look at their sales revenue, it's around 6 million. Less cost of goods sold is 3,100,000, which will give their gross profit is 2.9 million. And when we look at their operating expenses, it's around 970,000, and their operating profits will be 1.93 million. And how about their less? It means their interest expense is around 200,000. And when we look at their net profit before tax is 1.73 million. But when we calculate with their tax, which is around 40%, 692,000, and their net profit after tax will be 1,038,000. Less cash dividends, 40% of net profits after tax, which is 415,200, and their retail earnings will be 662,800. So in summary, we can conclude that pro forma income statement for Provincial Imports Berhad for the year ended December 31st, 2024 projected that their sales revenue is around 6 million. When we look at their net profit after tax, it's around 1,038,000, and their retail earnings is around 622,800.
Hi, good day. My name is Bharat Sivaraj. I will be continuing from the second question, part B, in following Mr. Naga's presentation just now. Alright, as we saw the financial statement, now we are looking at the balance sheet of, this is the pro forma balance sheet for Provincial Imports Berhad as of December 31st, 2024. As we can see the balance sheet here, it did not balance and out of balance as for 288,200 ringgit. Let me just go through the detail of it. The projected amounts for 2024 was cash of 400,000 ringgit, doubled from the previous year. Marketable securities 225,000, which is unchanged. Accounts receivable is 750,000 ringgit, and this we with the estimated cost from the previous year, and the formula of 1.2 we derive from the increase in the total revenue, sales revenue. 1 million increase of in 2024, which is about 20% from the previous year's 5 million ringgit. So hence we derive to 1.2. So so the account receivable we calculate such a way that we times with 1.2 times of the 625,000 of the previous year. All right, inventories 1 million, doubled from the previous amount. Net fixed asset is 1,646,000. Accounts payable 840,000 ringgit, again 1.2 times of the previous year 700,000 ringgit. Taxes payable is 114,000 ringgit, again the same formula. Notes payable 200,000 ringgit, which is unchanged. Other current liabilities 6,000 ringgit. Long term debt 500,000 ringgit. Common stock 75,000 ringgit, and retained earnings is 1,997,000 ringgit and 800 from the previous pro forma statement. The balance is the balance sheet is out of balance by 288,200 ringgit. The retained earning amount needs to be adjusted by this amount to make the balance sheet balance. So the solution is the adjusted retained earning equals to 1,997,800 minus the off balance amount, which is 288,200, which will give you a new adjusted retained earning of 1,709,000 ringgit and 600 ringgit. The pro forma balance sheet for Provincial Import Berhad as of December 31st, 2024 should be then balanced this way, where the total asset equals to total liabilities and stockholders' equity at RM 4,021,000 ringgit. Alright, now we look at the question C, alright, which has stated due to the increase in sales revenue, the potential of our company Provincial Import Berhad to get financial support externally. Alright, based on the pro forma financial statement, Provincial Imports Berhad financial performance is expected to improve in 2024. The company projects a higher sales revenue, net profits and retained earnings compared to the previous year. However, the firm may require external financing to support its growth and maintain a healthy financial position. So the increase in accounts receivable and inventories may put pressure on the company's liquidity, necessitating additional financing accordingly. Alright, so Provincial Import Berhad should also consider the impact of its financial performance on its corporate social responsibility initiatives, as these factors are increasingly interlinked. Effective corporate governance, including the role of the board and audit committee, can help the company navigate these challenges and ensure sustainable financial performance.